Everyone thinks Warren Buffett got rich from picking the right stocks. That's not even close to the real secret. What he actually did was far simpler and far harder. Today, Warren Buffett is worth over $120 billion. His company, Berkshire Hathaway, is valued at $900 billion. That's more than the GDP of most countries. But here's what makes him different. He still lives in the same house he bought in 1958 for $31,500. He drives himself to work. He drinks 5 Cokes a day and eats McDonald's for breakfast. The real secret wasn't picking stocks. It was buying entire businesses when they were cheap, and then never selling them. It's so obvious it sounds boring, but boring made him one of the richest people alive. Every time you contribute to your 401k, every time you check your retirement account, you're using his principles. Index funds, buy and hold strategies, long-term thinking, that's all him. Our story begins in Omaha, Nebraska, 1930. The Great Depression is crushing America. Banks are failing. Fortunes are evaporating. August 30th, 1930. While banks were collapsing across America, Layla and Howard Buffett welcomed their son, Warren. Howard was a stockbroker, one of the few jobs that still existed during the Depression. By age 6, Warren was already different. He'd buy 6 packs of Coca-Cola for 25 cents and sell each bottle door to door for 5 cents. A nickel profit wasn't much. But multiply it by hundreds of bottles, and suddenly the math started making sense. At age 11, he bought his first stock, Citi's Service Preferred shares at $38 each. He bought 3 shares with money he'd saved. Then, he watched the price drop to $27. He held on. When it hit $40, he sold, small profit. But he just learned the most expensive lesson of his life. The stock kept climbing to $200. He'd sold too early. The lesson? Patience. Don't just buy low and sell high. Buy low and hold forever. That one mistake shaped the next 70 years of his investing career. He studied business at the University of Pennsylvania, then transferred to Nebraska, then Columbia. At Columbia, he met the man who would change everything. Benjamin Graham, the father of value investing. Graham taught him something radical. Most people buy stocks, pieces of paper that go up and down. Graham said, forget the stock, buy the business, and only buy it when it's selling for less than it's actually worth. It was so simple it sounded obvious. Find companies selling for 50 cents that are worth $1. Buy them, hold them. Let math do the work. Almost nobody was doing it, and the ones who were, they were getting rich, quietly. After graduation, Warren had options. He could have stayed in New York, climbed the Wall Street ladder, made good money in a nice office. Instead, he moved back to Omaha with $10,000 and a plan. In 1956, at age 25, he started an investment partnership out of his bedroom. 7 family members and friends invested $105,000. Warren invested $100. He didn't need their money. He needed to prove the system worked. His first investments weren't glamorous. Gas stations nobody wanted. Textile mills everyone was abandoning. Boring companies with ugly balance sheets. His friends thought he was wasting his education, but Warren saw something they didn't. These companies were selling for less than the cash in their bank accounts. It was like buying $1 for 40 cents. The market wasn't rational, it was emotional, and emotion creates opportunity. The returns started rolling in, 10% per year, then 20%, then 30%. While the market averaged 7%, Warren Buffett's partnership was crushing it. By 1962, he was managing $7 million, and people were starting to notice. His strategy was absurdly simple. Find a business worth $1, pay 50 cents. Wait. The gap between price and value always closes eventually. It's not about predicting the future, it's about doing math in the present. Graham called it the margin of safety. Never pay full price. Always leave room for error. The market will panic. Companies will stumble. But if you bought cheap enough, you're protected. Safety isn't exciting, but it compounds. By 1965, Warren Buffett's partnership had generated returns of 29% annually, while the market did 8%. $100,000 invested with him in 1956 was now worth over $1 million, and he was just getting started. In 1965, he bought control of Berkshire Hathaway, a struggling textile mill, for $14 per share. The company was dying. The textile business had no future. Most people thought he'd made his first major mistake. But Warren Buffett didn't buy it for textiles. He bought it for the cash sitting in the company's bank account. Berkshire was bleeding money in textiles, but it had millions just sitting there, cash he could use to buy better businesses. It was one of the most important decisions he ever made. Stop trying to save a dying business. Use its resources to buy winning ones. Berkshire Hathaway, the textile company, died, but Berkshire Hathaway, the investment vehicle, was born. His next move was brilliant. He started buying insurance companies. National Indemnity, GEICO, General Re, one after another. And insurance companies have a magic trick that most people don't understand. Insurance companies collect premiums today. They pay claims tomorrow, sometimes years later. That gap between collecting money and paying it out, that's called float. And float is essentially free money you can invest. Berkshire's insurance companies collected billions in premiums. Warren Buffett took that float, money that wasn't technically his yet, and invested it. He bought Coca-Cola, American Express, Apple. The investments made money, and the float kept growing. By the 1980s, Berkshire had permanent access to billions in float. It was like getting an interest-free loan that never had to be repaid, as long as you kept writing insurance policies. Nobody else was doing this at this scale. He wasn't just picking stocks anymore. He was building a machine. Insurance premiums came in. Float got invested. Investments compounded. Profits bought more insurance companies. More float. More investments. A loop that fed itself. Through the 70s, 80s, and 90s, Berkshire kept buying. Nebraska Furniture Mart, Scott Fetzer, Flight Safety. Businesses that made boring products. Boring is good. Boring means predictable, and predictable means you can calculate value. In 1972, he bought See's Candies for $25 million. People thought he overpaid, but See's made $4 million in profit every year, and every year they raised prices just a little. By 2020, See's had generated over $2 billion in profit. In the 80s and 90s, he made his biggest bets. Washington Post, Coca-Cola, American Express. Not tech companies, not trendy startups, just boring businesses that sold things people bought every single day. He had a rule: only invest in businesses you understand. He didn't buy tech stocks during the dot-com boom. Everyone called him outdated. Then the boom crashed. The boring companies, they kept making money. By 1990, a single share of Berkshire Hathaway stock cost $7,000. By 2000, $70,000. By 2021, over $400,000 per share. He never split the stock. If you wanted in, you paid full price, no shortcuts. Today, Berkshire Hathaway owns over 60 companies outright. GEICO, Dairy Queen, Duracell, BNSF Railway, Fruit of the Loom. These aren't investments. Berkshire owns them completely, along with massive stakes in Apple, Coca-Cola, and Bank of America. The company employs 360,000 people across insurance, energy, manufacturing, retail, and transportation. It generates over $300 billion in revenue annually. It's not a company, it's an economy, but there were costs. When Berkshire finally shut down its original textile mills, hundreds of workers lost their jobs. Manufacturing moved overseas. Towns that depended on those mills struggled. Rational business decisions aren't always popular ones. Warren Buffett was ruthlessly logical. If a business couldn't compete, close it. If management wasn't performing, replace them. Good for shareholders, hard on people. He wasn't cruel, he was systematic, and the system had no room for sentiment. As Berkshire grew, regulators started watching. How much control is too much? When does success become monopoly? In insurance, energy, and railways, Berkshire held enormous market power. Congress asked questions. Warren Buffett had answers, legal ones. He became a symbol of tax policy debates. His famous line, "My secretary pays a higher tax rate than I do." He advocated for higher taxes on the wealthy while legally minimizing his own. Principled? Hypocritical? Depends who you ask. Here's how the machine actually works. Insurance companies collect $140 billion in premiums annually. They invest that float in stocks and wholly owned businesses. Those investments generate returns. Those returns buy more businesses. More businesses mean more cash to invest. The real secret? Time. Compound interest over 60 years. 7% annual returns for 60 years turns $10,000 into $6 million. Berkshire averaged better than 20% for decades. That's how you get to $900 billion. He changed investing forever. Before Warren Buffett, value investing was a niche strategy. Now it's mainstream. Before Warren Buffett, individual investors rarely beat the market. Now, millions try using his exact principles. Index funds, buy and hold strategies, long-term thinking over short-term trading. He didn't invent these ideas, but he proved they worked, at scale, for decades, against every market crash, recession, and bubble. At his peak in 2008, Warren Buffett became the richest person on Earth, worth $62 billion. He'd overtaken Bill Gates, not through technology or disruption, through patience, mathematics, and refusing to sell. By 2021, Berkshire Hathaway Class A shares traded at over $400,000 each. If you'd bought one share in 1965 for $19, it would be worth millions today. One share, 60 years of patience. That's the entire secret. Today, at 94 years old, Warren Buffett still lives in the same house in Omaha he bought in 1958 for $31,500, still drives himself to the office, still reads annual reports for hours, still drinks 5 Cokes a day. He doesn't own a yacht, doesn't have a private chef. His car isn't exotic. The richest investor in history lives like a comfortable accountant from the Midwest. Because the money was never the point, the game was. In 2006, he announced the Giving Pledge. He's donating 99% of his wealth to charity. Over $130 billion committed to the Bill and Melinda Gates Foundation and his children's foundations. He's systematically giving it all away. His children won't inherit billions. They'll get millions, enough to do anything, not enough to do nothing. He's funding causes that will outlive him by centuries: education, health, poverty reduction, the compound interest of generosity. Every time you contribute to your 401k, you're using his strategy. Every time you buy an index fund, you're following his advice. Every time you hold an investment through a crash, you're applying his patience. Target date retirement funds, automatic portfolio rebalancing, low-cost index investing. These are all built on foundations he helped create. Millions of people are building wealth using principles he spent 70 years proving. The kid who bought his first stock at age 11 became the greatest investor who ever lived. Not through genius trades, not through perfect timing, not through luck, but through patience that most people will never have. The secret was always hiding in plain sight. Buy good businesses at fair prices. Never sell. Let compound interest work for 60 years. It's not complicated. It's just impossibly hard to actually do. That's how you build $100 billion. One patient decision at a time. If you want to see more stories of how success was actually built, subscribe to Success Built. We break down the strategies, the decisions, and the systems behind the world's greatest business empires. New documentary every week. Hit subscribe, hit the bell. Let's uncover how success is really built.